One of my operating partners has joked with me that if Fru had a tattoo, it would stand for GSD, which is get blank done.
In this episode of Investors and Operators, I'm chatting with John Fruehwirth, who is managing partner at Rotunda Capital Partners, which is investing out of a $735 million Fund 4 raised in May of this year, 2025. John, we're going to do some really interesting topics today. Let's kind of go over these. First, we're going to do a warm-up question. Then we're going to go into the evolution of you from an independent sponsor to raising institutional funds, some of the key lessons from fundraising. I'd like to talk about AGM structure and how you guys do it. Okay. Then I want to switch over to value creation. You recently had your SXO conference, so I'd love to hear about how you guys discussed accelerating value. Then we'll talk about talent and leadership. And last, we'll round it out with a fun story that you took on a over the pond on a fun journey that we'll cover later. And I'm going to keep that ambiguous. But the warm-up question is, if you had a tattoo, what would it say? And if you want to, where would it be?
Wow, the warm-up question. All right, Jordan, let's go. Well, there's two answers to that. I do not have a tattoo, but if I had one, I'm going to take two choices here. One, I'm a rabid Baltimore Ravens fan, so I think that would be on one of the upper bicep type area, maybe the Ravens logo. But two, actually, one of my operating partners has joked with me that if Fru had a tattoo, it would stand for GSD, which is get blank done. Which is, I had a high bias for action, high bias for motivation. So that might be the other one.
All right. This is not on, it's not going to be monetized on YouTube. So we can just say it's going to get shit done. All right. Good. All right. I love it. And is that left arm, right arm? Are we going with lower back tattoo for the beach?
No. Gotta get stuff done. So
I love it. Why would get shit done be the tattoo? Like why that versus other stuff?
Yeah, I think fundamentally, and this is true not just in private equity, but business in general, in my opinion, right? It's about execution. And I think a lot of people struggle with making decisions. They're afraid to make the wrong decision. And what I would find is if you just move forward, right? You think about it, you try and have a strategy, then get going. Just start, because it's impossible to predict where you're going to go. And if you get stuff done, you're moving step by step and you're giving yourself optionality, right? Everything you get done creates optionality by opening another door. Or you can sit there and not do anything. And I could study it, or what if this, or there's an alternative, and then by the time I'm on my fifth iteration, you're getting going, right? And I can guarantee for those iterations, I learned something a lot, and so if you're okay with making mistakes and getting, motion going forward, it's just going to accelerate you ahead of the competition, right? And so that's what I try and encourage is risk-taking prudently, but risk-taking, let's just try things. So we'll talk about the value creation team later, but as an example, try a different type of analysis, try a pricing project, try a marketing dashboard, and if it works, great. And if it doesn't work, when we invested in data analytics team 7 years ago, lower middle market firms didn't have data scientists on their team. We now have 3, right? And I can't tell you the number of projects that we have tried. Some of them have worked spectacularly well. Some of them have not. But I guarantee you that if we hadn't got started 7 years ago, we wouldn't have the knowledge and the moat that we built up around data and analytics that we have today. And so I encourage the team to keep making those mistakes, keep pushing on the envelope. So GSD.
Is there a risk that you took that you can remember that was an example of living that, like you personally, and you're like, you know what, this is literally what it means to GSD. Like I took a risk, it didn't work, it didn't break the bank, didn't break the infrastructure, but this was a risk and it didn't work.
Where it didn't work.
Or let's do both. One that did work,
okay,
and one that didn't work.
Yeah. My dad passed away when I was in high school. So, we didn't have money for college. So I had to find my own way for college. So I started all these little businesses, some worked, some didn't, but I scrapped and clawed, and it basically, it made enough. I went to University of Wisconsin, This is a long time ago. Tuition was $682 a semester for 15 credits. And I was able to make enough to pay tuition and, rent an apartment with some of my buddies. And, I graduated from college. And, those weren't huge successes by any means, but it was, just a bias to action. Um, but right after college, I'll give you another example of just moving forward and taking a risk. It simply was I had an opportunity to go work for an oil company, and everyone wanted to work. You got to work in a couple locations, one near Philadelphia, one in Denver, one in Houston at the headquarters, one in the middle of nowhere, Oklahoma, and one in the middle of Louisiana. And I chose Louisiana, right? Because it was the one spot in the country where we were in transportation, downstream oil transportation. We had boats on the inland marine on the Gulf Coast. We had pipeline. We had offshore pipeline coming in. We had trucks, right? And so it was, if you were going to be in transportation of both light oils and heavy oils, it was the best spot to learn. The refinery was there as well. And so everyone was like going to Louisiana. And I spent 18 months down there, and it was an invaluable training ground. And then they gave me a chance to move to Delaware and help, learn to run a truck terminal. So I had Teamster drivers. We had 36 power units. We had drivers. I had 7, bay mechanic, to fix all the equipment. And it was just at 22, 3, 4 years old. It was just a tremendous learning experience. And it gives me today actually an appreciation when we're working with one of our portcos. It's hard. What our portfolio company CEOs do is hard to operate. Not saying the private equity isn't hard, but it's a different type of hard. And I think just having that experience for 5 or 6 years prior to going back to business school was really a great opportunity. And it was a chance that a lot of people wouldn't take. Everyone wanted to go into investment banking or management consulting or these other careers. I just took a little bit different path.
I love it. Investors and Operators is the podcast of 51 Labs, a full-service digital marketing agency that focuses on private equity firms, the portfolio companies, and others in the M&A market. We handle everything from branding to video to websites, LinkedIn content, and everywhere in between. We've done over 150 projects since 2019, and usually we do a lot of work with emerging managers, so funds 1 through 3, independent sponsors, but also funded private equity firms. Reach out, happy to help out. Let's talk about after B school. When you look at this journey over the past 17 years from independent sponsor to institutional funds,
Mm-hmm.
where does this journey start?
Yeah. So after business school, my fiance and I moved to Charlotte, North Carolina, and took up with a regional bank that was First Union, became Wachovia, became Wells. And in that time, I started out as a senior lender, then was doing mezzanine lending, then I was doing everything up and down the right side of the balance sheet. After several years, an opportunity arose to move to Chicago with a publicly traded BDC that had several billion of capital that was doing kind of the same things, so not senior debt, but mezz debt, fund investing, direct investing. And so I did that for a couple of years, moved to DC, met my partners who, two of my partners and I'm still today. And, it was just a great experience to, a lot of equity guys think about the upside, right? And of course I think about the upside, but in the history of baseball, no one has ever scored a run without getting to first base. In investing, that's about getting your capital back. Like that's your single. You just get your capital back. Then you figure out how you hit a double, a triple, and occasionally you plink one and get a home run. So being a lender first has actually been a really creative and interesting experience in my life. To think about it, and how we invest. And all three of my partners, excuse me, all 4 of us have been lenders in a previous life. And I think it actually is a point of differentiation for Rotunda along the way. But I was at this publicly traded BDC, about 5 billion at this time. We had 125 positions. About 100 were mezzanine debt. About 25 were controlled deals. It's early 2008. I got promoted to head of private finance, which everyone called me deputy dog. Who's deputy head of private finance. But it was a great learning opportunity. But in addition to doing deals, I was responsible for the origination team and some of the ops team and learning how to run a multi-billion-dollar, publicly traded platform, right? As a junior executive on the senior team, if you will. But it was early '08, and, it was '08. And by the end of '08, our COO had, announced that she had been retiring, which was really where I was gonna get slotted, and then she announced she was unretiring, and I figured out who was getting retired pretty quickly. And so I ended up having to leave the firm at the end of '08. And, that's hard. I've never been laid off or let go from anything. And, it's a humbling experience for sure. But as it turns out, that actually ended up being the genesis of Rotunda Capital and the story we have today. So the CEO and I had a very good relationship, but he had to downsize the firm, and we were able to buy back a couple of our old deals. Is how we started. So I left at the end of '08. My partner Dan Lipson and ultimately Bob Wickham joined in '09 and early '10 when the old firm was ultimately sold to Ares. We got a couple deals done as an independent sponsor, and that was really fortunate for us to have that background because we could go out and talk to investors even in the '08, '09, '10 timeframe and be very clear and articulate with, we know we've sourced this company, we've worked on this company. This isn't just like I could buy a company. I could buy the company that I've bought before, and I can tell you the good and the bad and the ugly and what we're going to do with it and why this is going to be successful. And when we were fortunate, we had some very good early success with those deals, and one thing led to another, and turned us into being an independent sponsor for 10 years and 12 deals later. It wasn't exactly how we planned it. Um, and Corey joined us along the way. So the four of us, have been together as partners since January of 2013. So coming up on 13 years, the four of us. But I've known Corey since 2003. I've known Dan and Bob and worked together with them since 2005. So, we have 20 plus years experience working together individually and collectively, which
Talk
will
more
be
about
beneficial.
how the four of you stayed together. I mean, that's a long time for a partnership. Like
Yeah.
how what would have been some of the key ingredients of keeping the team together? Maybe some friction points. Like how'd you work through them?
Yeah. I think one of the keys is we have a concept at Rotunda that disrespect the idea, respect your colleague. And so when I bring a new employee on at Rotunda, we always have a conversation that anyone in the firm is welcome to join investment committee. We have the whole firm together on Monday morning meetings. We have the whole firm together for twice a year strategy sessions because we have an office in Chicago and an office in DC. We try and be, transparent about what we're doing as a firm. You're allowed to ask any question other than other people's compensation is off limits, but anything else, what's our strategy? How are we thinking about fundraising? What are we going to do with the value creation team or the execution team? All that. If you want to know, just ask. But at investment committee, the idea should be, Jordan, you're not getting it. You're not listening. Stop. There's a risk you're not seeing. You're not, I want to push on this. I don't think you guys are focused on the right growth strategy. I don't think your analysis of how you're going to grow the company is insufficient. So disrespect the idea. 100% valued, 100% allowed. If you come across the table and say, Jordan, you're an idiot, that's going to get you a trip to the woodshed, because everyone at the firm has value, whether they're, a managing partner, whether they're on the value creation team, whether they're on the administrative team, on the finance team, everyone has a voice, everyone has, an opinion. If you look at our firm too, we've tried to hire from a diverse set of people, and I think that's intentional, right? In bringing in different opinions, because my view is on a diverse team. Some people will be first gen. Some people will have been here, a very long time. Some people will have a entrepreneur for a parent, right? And they maybe relate to growing up and not having a lot of money, and mom and dad couldn't make payroll, so there was no Christmas presents. Other people have grown up in a more privileged environment. Some people are, different ethnicities and grew up in different cultures, right? And all that plays into when we're making a decision. I have no idea what people's backgrounds and networks are when we hire them, right? But ostensibly they're smart and they're talented, and they're hardworking, right? And that's why we want to make sure everyone has a voice within IC. And I think when you ask about how do you stay together, it's respecting each other, even though we disagree. We disagree on a lot of things. Um, but it's if we can't get to the point of consensus, then we just shouldn't do something, right? Whether it's a firm decision or an investment, right? If there's plenty of other things we can always do, and we don't have to do any one given deal. And as everyone in this space knows, a tough deal costs you more time and energy and angst than a good deal, right? And so if you avoid the one deal because someone's got a real reservation with it, fine, move on. get the next one. It's kind of our strategy, right? And I think we also build a culture that focuses on team over self. We do that through compensation systems. We do that for how we reward people and promote people, right? We say all the time that no one at this firm has ever had a good deal, and no one at this firm has had a bad deal. We have had a bad deal. We have had a good deal, right? And when people get sick or go out of maternity leave or, need to care for a relative, then everyone else picks up the slack and steps in, right? And so it's that kind of a culture. So we've only had two or three people, you know, quit the firm over the 16-year history of the firm. I mean, we've let people go for performance reasons. And the other part of that is sharing economics. I think Bob and Dan, Corey and myself, I think we've always had this view that, we want people to have a long-term pathway to wealth generation for them, themselves and their families, which means they've got to write a check. So one of the things we do differently around culture is we write a fairly large GP check, and it starts at the senior associate level, not at the VP level, right? And so, these are young people, late 20s, early 30s. They're trying to have families. They're trying to buy a house. They're trying to get their minivan. And, maybe it's 50, 100, $200,000 commitment to the fund, but it's intensely personal to them. And therefore, if we treat it like everyone's putting their own money in and everyone's value, opinion is valued, then what you get to is an environment where, you work on the team, not about this is my deal, or I did this, or I sourced that, or I value created this thing. Don't care, right? We win and lose as a team. Full stop.
Has that mentality been with you for a long time, or has it kind of evolved? Like, did it start with junior sports and like your coach just pounded it into you guys? Like, or how have you kind of come to that approach?
Yeah, I think two things. One is I played high school sports. I didn't play in college or beyond that. But a number of the guys on the team, some of the women on the team, we've got two women that swam in college. We've got a college football player. We have a college lacrosse player. So that's not accidental, right? That teamwork and ethos sort of pervades. The other part of it is, I took the oath of office for the Marine Corps, but ultimately couldn't serve due to psoriasis way back when. But my family has a military culture and military history, particularly Navy Marine Corps. And so again, it's about team, it's about mission, it's not about self. And I think that's, I've coached 22 years of youth baseball. I've got three kids, three wonderful kids, and spent a lot of time on soccer fields and lacrosse fields and baseball fields and softball fields and swim meets. And, again, it's about, yes, you're the individual contributor at that moment, but it's about the team and winning as a team. So that this isn't something new. This is just how I run my life.
I love it. So continue the journey from independent sponsor to raising your institutional funds. Like, what was that transition like?
Yeah, it was actually a really, really hard decision because we had been, fairly successful as an independent sponsor, had really generated some nice returns. Um, you get the luxury of sitting on fastball middle and waiting for your pitch as an independent sponsor and swinging, occasionally. You don't have high deal velocity. But what you lack and what we had a couple different issues. Point one is we saw there was such an opportunity to do more with the companies and create more value if we had a team that could help us do that. And to have a team, you have to have salary and you have to have benefits and you have to scale the firm. It can't just be four guys running a really nice looking popsicle stand. And so that was point one. Point two, multiple times we would work on a deal and we would get to the end of the deal and it maybe would be, you couldn't really compete in a process per se, but there was always other people around. And then three or four times we got done after spending months and months working on something. And they're like, well, John, you got to go out and raise the money. And if you're not successful, it puts kind of a weird hex on my company. Jordan over here, he's got a fund. He can do add-ons. It's just safer to go with him. And your opportunity cost your time is huge. And so that took a couple times. And then the last point is we had a tough deal. As an independent sponsor, if you do a deal at par and the next round of capital that comes in to support the company literally was valued at 23 cents on the dollar, you don't have a lot of other investors that want to pony up after they, seemingly lost, 77 cents of their original investment. So that made it very difficult. That being said, we had reasons to believe that that company would turn around. It took us almost 8 years and we made just under three times our money. blended. But it's an independent sponsor. It's very hard to raise a down round. So for all those reasons, we ultimately decided in 2019 to raise our first, institutional fund. We were fortunate enough to get a good placement agent that was willing to help us. But we made some mistakes along the way too. We went out to raise 175 million. We raised just 196. We started in 2019, then COVID hit. That took a while, so it took us about 18 months to get that first fund raised. But we made a bunch of mistakes. As an independent sponsor, every deal, the economics of every deal can be independent of the next deal, right? Or the former deal. So we had this weird carry structure. Instead of a 20 over an 8, it was 5 hard hurdle, 80-20 to 2.5, and 70-30 thereafter. And when you're trying to explain what institutional investors deemed as premium economics, uh, it doesn't matter that I still can argue that that structure is better than the traditional structure. Because I'll tell you, if you do the math, you'll find that the lines cross right at about 3x. And so if we're getting paid more above 3x, what do you care? Because you've got significant as an LP downside protection. But Rotunda Capital and John Fruehwirth were not going to change the way the world works. So big lesson learned there. Um,
So
you know,
lesson one for raising the first institutional fund is don't try to reinvent the wheel for
no,
LPs.
for sure. Point one. There's at any given time 3 to 5,000 funds raising, right? And if you got to think of it through the lens of an LP, uh, they have minutes in some cases to make a decision about whether you're somebody that they want to have another meeting with and get to know. And if you put up impediments to them, your strategy isn't clear. You can't articulate why you exist. Your team hasn't been together for a long time. You don't have a viable track record that shows both, sourcing the deals, but also exiting the deals. You have a weird carry structure. You have some weird fund economics. Anything about that, any impediment, just gives the LP a chance to say thanks, no, on to the one of the other 3,000 things that I could, be focused on. And it's interesting. I had an LP recently tell me we only do family founder deals, and he said, "Do you think that that is a strategy, or do you think that that is a filter?" And I'd never been asked that question. And I said, it's a filter for sure. And he laughed. He goes, that's the right answer. Right. So many people say my strategy is to do family founder deals. He goes, yeah, well, I've got over 200 firms that just do family founder deals. Like that's just a filter. That's the type of deals you look for. That isn't what you do with them. That isn't your sourcing strategy. Um, no, lesson two is we used to do financial services. So we're an industrials firm. So for us, that means distribution, light manufacturing, industrial services, those type of deals. We historically had been very successful doing um, largely specialty finance. But when you go out with distribution, industrial services, and small ticket leasing, financial services, specialty finance, it was like apple, orange, fishing rod, right? And they couldn't figure out what to do with that. And that was another lesson learned, I think, is that be good at one thing and be good because the LPs themselves are going to learn to find the healthcare guy and the industrials person, right? And the woman that does business services particularly well, or CPG or whatever, right? And when you try and start mixing strategies as a first time fund, it's really hard for those LPs to understand who you are. Now, as your fund complex scales, there's plenty of very, very successful fund managers who have different strategies around different verticals, but that's not something I would try again as a first time fund manager.
It's interesting. Barry Uphoff from Martis Capital had the exact same thing when he was talking about. He's like, I had venture deals, I had buyout deals.
Yeah,
Now they're in healthcare, but the strategies were a little bit confusing. And I think the takeaway is make life easier, not harder, for people who see thousands and thousands of people who look very similar in
very
size
simple.
and shape and style.
Yeah, I sort of joke we won't use the P words, proprietary and playbook, but you got to think of it as you go to like Super Return in Berlin, right? These people are meeting 12 to 15 managers a day for 5 days in a row. What are they going to grab onto that makes you different and memorable from the other 40, 50, 60 managers that they're going to see in a blur, right? So that was the other thing I think I would say we learned is in that process is you got to boil it down to 3 points. Whatever your 3 points of differentiation or connectivity, however you want to describe it, that's if you can get that across in the first meeting. So when we start investor relations fundraising meeting, we say, look, if you only had 5 minutes, here are the three things that differentiate Rotunda. Then we're going to talk about those over the course of the next 45 minutes, because I think that's what you've got to take back. And if that's interesting to you, then we'll have a second or a third meeting and we can learn more
What
about those areas.
what makes you memorable? Because when I hear buyout industrials, like, okay, how do I remember that?
Uh, how you remember that is certainly not my nice hair. No, no, in all seriousness, the three things that we say is, look, as an independent sponsor, we couldn't participate in broad auction processes. So we had to learn how to source thematically. And everyone comes in and says, oh, we have our proprietary sourcing, algorithm or whatever they do. The reality for us is, and this is data, right? That roughly 55, it seemed to be 60% of our deals that we've done in a structured fund concept came from, with no banker involved, right? So we have to kind of come on with a thesis. We have to find operating partners. We have to go to the World of Concrete show, right? We have to meet different operators. We start by meeting guys that have $500,000 to $1 million of EBITDA, test out our thesis. The type of companies in which we invest are not sexy, and we don't do anything that's really sexy to those companies, right? So this is blocking and tackling. And these family founder owners, though, are very concerned about private equity, right? They've heard all the shark stories and the bad, you're going to come in here and you're going to fire my people and you're going to change my culture. And so how do start building a track record of testimonials, right? We communicate the four core values, right? Which are partnership, integrity, transparency, and excellence, right? That's a way to differentiate yourself. So the thematic sourcing, that takes 12 to 24 months to find a deal. So that's really point number one. Point number two is we've developed a strategy map process. So let's agree to get the value creation team, the execution team, and the management team on the very same page, both before we close on the deal. So at LOI stage, we share our vision for the company. And if you don't agree, and we've had people say thanks, but no, we're going to change X, Y, and Z. Well, no, my Dave is the CFO. Dave is not going to be the CFO. Let's just have an honest conversation about that. Or if you're the founder, do you want to stay on and run the business? Do you want to be on the board? You always have to roll over. We won't do a deal where they cash out. So what's the strategy going to be? How are we going to affect that? How do we have the tactics? So that's point two. And I can give you chapter and verse on how we do that. And point number three is this data and analytics. We have Charlie and Nathan and Jorge now. Um, they're really a secret weapon because they can help us both in diligence. These are, again, family founder companies, rarely audited. Often data is a mess. They don't understand where they make money. And so the ability for us to go in early and just grab the root data, the block data, and then actually, manipulate it to figure out, are they growing only by raising prices? Are they growing with volume, but they haven't raised price in 4 years? What product categories are profitable for them? Customers are profitable. And that's the kind of work that we can do. And then after the fact, how do we help them with strategic pricing, right? How do we think about Salesforce compensation systems? And a lot of that is rooted in data. So the three things, again, thematic sourcing, building a strategy map and the tactics to go with it, and then using data to make decisions. Corey has a phrase he likes to say, which is, I want you to know, I don't want you to think. And we see a lot of people go, yeah, I think the answer is like 4 to 8 versus the answer is 7, and I'll tell you why. Right. And so when we sell a business, typically it goes to a larger private equity firm 70% of the time. Right. What we want to have is something that is growing organically and through M&A, so buy and build, using data to make decisions as a full-on data stack, a data lake that they can use to drive, KPI-based decision making, and has all the requisite functional areas of a company, right? So HR and IT and finance and all that, right? If we can deliver that to the next buyer, we can generally buy at attractive multiples because we're sourcing our deals. We're not competing in a broad process with 150 of our other friends. We've tripled or quadrupled the size of the company. We've delivered all the things I just said. The next buyer will pay for that because we're delivering a quality platform, hopefully, to the next buyer that they don't have to then spend 2 years integrating. We've done that work.
Can you talk about how your team structure has evolved over the different institutional funds? Like, when did you make that investment in the first data person or the BD person or an IR person? Can you just talk about what you did well in constructing the team, and maybe what you would have done different at maybe the first fund.
Okay. Yeah. Actually, Nathan was probably our first hire on the value creation team. Nathan is our lead data scientist. And so the thing that all three actually, oddly enough, have MBAs from Kellogg, so they can both be technically proficient. Charlie's got a master's in data science from Cal Berkeley, but also has an MBA from Kellogg. So they can straddle the wall of data and technical, proficiency, and also understanding of business and the business problems and what we're trying to solve. So that was the first hire. So that's something I think we did well that we got involved in. I think we had a BD person. He ended up leaving, went to another fund, has done very well. We hired a wonderful woman, Margot. She worked at another fund, and she had become an expert in Deal Cloud. And while we sort of had Deal Cloud as a CRM system, we weren't ourselves using data to run the firm. And over the last several years, it's been transformed into a hugely valuable exercise. So every, of course, deal that comes in the shop is now recorded. And so we can see trends. We can track where we're seeing deals from. We track quality deal flow. We track the pipelines by deals that we find, deals that others help us find, lots of different channels in there, but that's all tracked. So we have the data, point one. Point two, all of our investors, all the operating partners, all the lenders, every term sheet that we get is now in Deal Cloud, right? So that every time a new deal comes up and we say, oh, who should we take it out to, lending? What about firms X or Y or Z or what happened? Like, we just print it out. I can tell you every term sheet and every term that we've gotten in the last 3 or 4 years. And so Margot has been a big, and Mara, who works on that, building a branding and marketing effort. I think we've done a good job of that, right? And so we're posting on LinkedIn on a regular basis and thinking about
Can you
content.
can you go back to the data part? So that was 2019
Yeah. Yeah.
when you
Nathan joined us in 2019. I think Charlie joined in 2022 and Jorge joined in January of this year.
and that was like one of your first hires was a data scientist.
Data scientist. And then, we've hired, some generalist operating partners. We have an operating partner today that just does systems because on average, it's about 1.5 systems per company, systems being a ERP or a CRM or a warehouse management or transportation management system. And, if you've never done it, there is a way to do it well and there's a way not to do it well. Unfortunately, we've done both, but and again, that's where making mistakes and getting involved early. We have outside team though too. We have something called an SXO.
Yeah.
An
Well, I'm sorry,
SXO,
back on the operating partner at the fund level, when was
yep,
the first investment in a true operating partner?
that was Nathan on the data analytics. And then Ellen was the first operating partner that was more of a generalist. She's a CFO for a private equity backed platform. But she'd also been a turnaround consultant for Alix. And so she could, I sort of joke about our generalist operating partners. I call them head on a swivel. That's wrong. That's wrong. That's wrong. That's wrong. Right. They can go in and help us during diligence. So our value creation team has to present at investment committee and they have to commit to what they're going to get accomplished in the first year. And then we measure that. Right. And so it's broken out functionally. So the finance function we have some slider bars and some KPIs, metrics, if you will, and we assess where they are today and where we want them at the end of a year. And so the value creation team, each one of the major players, whether it's the systems, HR, IT, data and analytics, they all have done assessments of where they think the company is, and we have a rating rubric that goes with that. And then, over the course of the year, once we do the strategy map, which happens in the first month post closing, and we have agreed with the management team how we're going to go from New York to LA over 4 years, right, or something, right? Then that's great. Good idea. We want to go cross country. Well, how do we get to Cleveland and from Cleveland to Chicago to Omaha to ultimately to LA? And that's the trick in the management operating system. And that's what the generalist operating partners help us do, right? Which is break
Di-
down the
yeah.
big vision to tactical.
Did you feel like you hired Nathan and the data analytics expertise first because you and your three other partners had more operational experience, so you didn't need to fill that gap of hiring someone who's 15 years at Danaher to come over and be like, why was that? I guess I'm trying to dive a little bit deeper in that decision-making process.
Yeah, I think ultimately uh, we felt like we had enough, and we also were using some outside consultants, right? So you can rent
Okay.
or buy a value creation tool. We could look at a Carlisle, Blackstone, or KKR. They had these big data analytics teams, and we started thinking like, look, we really need to help our our teams with this sort of capability, and we tried it in a consultative environment, and it doesn't work. In my opinion, it doesn't work very well. And the reason it doesn't work is these small family founder companies, the data is not structured. It's completely messy. We had a company in Florida one time that they pulled out a filing cabinet, and every day they printed off out of their system. We sold 100 at $5 and 72 at $9.25. And that was their quote system. Charlie had to take 5,000 to 6,000 pages of data, get it into a data cube and manipulate it so we could figure out, and we passed on that deal. We figured out that they were growing only by price. They hadn't grown volume at any of their customers. They hadn't grown store feet. They hadn't grown unit count, in a number of, so having the data is actually like an investment decision, if you will, right? How do we avoid a bad deal by delving into these family founder companies a little bit deeper earlier? And
Yeah.
also, you could see the trend. We didn't think about AI back in 2018 and 2019. I'm not going to sit here and say I had this big prophecy, but we did know enough that if we could really understand where they're making money and losing money, we could differentiate ourselves quickly and really add value that way.
Um, what about people from a, traditional strategy consulting experience, whether, associate or, to more senior? Have you include that on your team? When did you? What level?
We haven't included that on the team so far. That's been a debate. So not never say never.
It looks like it's an active debate by looking at your face.
Yeah, yeah. Well, look, there's a constraint. There's a budgetary constraint too, right? We can't have everyone. So how do we think about what's the greatest value? I think this goes back to your tattoo question, right? At the end of the day, you can have the greatest strategy in the world, but if you don't get it tactically executed, then it's hard to do it. On the other hand, I'm very close with someone that was a former partner at BCG, is an expert at discerning why customers buy, and I absolutely see the value of that type of intellectual approach. I don't think we do. I don't think a lot of firms do, but I think we can do a better job of really delving into customers and why they buy. And I think that's potentially the next leg of something that we should be working on here at Rotunda. But I'll give you a case in point as an example. We used to have a deal, still one of my favorite companies I've ever worked on, called McQueen, and it was in Minneapolis, and they sold heavy duty equipment to cities, basically fire trucks and snowplows and street sweepers. And when we did the deal, we didn't understand that when you buy a fire truck, you get a fire truck, maybe a pump on it. There's no ladders, no hoses, no turnout gear, no jaws alike, no nothing. And by asking the customer what they wanted, because unless you're in a huge city, if you're Minneapolis or New York or whatever, you got hundreds, if not thousands, of pieces of fire apparatus. But if you're a small town, you're buying a new truck every 5 to 7 years on average. And what's happening is the fire chief has to go out and figure out where to get ladders. And he said they all told us, if you could make a comprehensive solution where we could be a one-stop shop, that would be amazing. Listen to the customer. We put it in. We have a deal in Wisconsin right now. They're doing the customer work last year. But the customer said, they do what's called vendor managed inventory. They keep the lines full. It's a company that manufactures stuff, and then we keep the parts and the components in the bins, amongst other things. And they said, well, I don't know why they haven't asked us for the stuff to the left or the right of the stuff that they currently do. And when we asked the management team, they're like, really? They would give that to us? So strategy consulting combined with customer insight, there's a huge role for that. Absolutely.
That's interesting. Because I've seen some people hire that earlier, so it's not just I'm gonna, go to LEK, EYP, or MBB to do the the CDD work, but
Yeah.
like viewing it as a core lever and
Yeah.
hiring it earlier because like okay, we bought it now, like we need someone to do that post act, like true strategy work, not the pricing, but like more market sizing things like that. But it's interesting just kind of hear where
We
you
get, I mean, we get market studies, so I'm not to say we don't do the work, right? We just don't have that resident on the team today, right?
interesting.
Um,
What's the difference, do you think, between the 2019 version of you
mhm.
raising that, and then the next fund, and then the next one? Like, how do you think that you and maybe the four of you, the four partners, have really evolved
Yeah.
since 2019?
Um, yeah, I think that look, we try and do the best we can in terms of putting our own strategy map together, right? If it's good for the goose, it's good for the gander. So we actually just held an updated strategy map session a couple weeks ago, about a month ago, where we laid out the next 3 or 4 years and try to be intentional about where the firm is going. What capabilities do we lack? How do we add those capabilities? Be honest with what we've done well and also what we haven't. Um, I think fundamentally there's 4 or 5 legs of any private equity firm, right? There's sourcing, there's execution, there's value creation, there's investor relations, and there's actually running the business. So if you take each one of those, I really do subscribe to the concept of 1% better, right? So if we continue to kind of push every one of those 5 legs of the stools to be just a little bit better every week, every month, every quarter, every year. So I don't want to sit here and say, hey, how are we radically different? It's amazing. I have an amazing team. Okay. We have some really talented people that work incredibly hard. And not that that's unusual. There's other, everyone would say that about their team, hopefully. But I think what we talked about with regard to culture, that continues today. Um, but the pace of um, change, the pace of deployment, the pace of value creation, it's all picked up, which is really exciting. And my point is, it's a learning culture, right? With a growth mindset. Again, we all hate the words. That's not how we've done it before, right? So the team, what I would say is that keeps me excited is I think the flywheel continues to accelerate. And what else can we add to the toolkit, right? What experience? How do we lever this sourcing idea across to another strategy? How do we take a value creation play, if you will, and run it to something else that's similar? So, case in point, if a deal does come in from a bank intermediary and we don't have a thesis on it, we haven't had an operating partner on it, we're probably not going to pursue it. If, however, it's in a space that we have an idea about, we want to make sure that's not a unicorn. That was one of the big learnings, right? As an independent sponsor, you're kind of trying to find a deal that makes sense that you could do something with. But maybe just honestly, it's kind of hard to draw a string through or line through that sometimes. Now, we don't want to waste time on a unicorn. If the learning and going to an MP and the travel and all the diligence work is part of a thesis, and that helps us learn and be better. Even if we don't win the deal, it's another brick in the wall, right? We just don't want to do some one-off deal and chase something that doesn't have applicability to anything else. So I think that's on the sourcing side how we've gotten better. Certainly the use of data and analytics with Margot and Mara. Point one. On the execution side, we have set back. Corey and Rohit led an effort to give, Bain years ago wrote a tremendous deck on how to run a private equity firm, right? And it's like 2014 or 2017, if you can find it. It's a couple hundred pages long. But in any case, they talk about the sweet spot. And so we did a complete teardown of 50 to 80 factors. What have we done well? What have we not done well? How do we rank them? What's most important? Which I'm not going to share publicly. And we judge every new deal, even at the IOI stage, against that rubric. So that's something we've improved on execution. Value creation, we could do a 2-hour show just on value creation, the things that we've learned, right? But iterating with 6, 7, 8 people on the team over the years. This SXO program that I know we'll get to in a minute, how do we had these strategy execution officers and how do we added those to the portfolio? We have a lean consultancy that helps us really optimize operations. The guys are former, big auto, and really helping us with quality and shop floor and process flow. So really building the tools and the toolkits. And then on investor relations, what I would say is you do business with people you know and trust. And so I think a lot of people there's 2 approaches, right? Which is continuous to fundraising or there's episodic. And if you show up every 4 years and you say, hey, look, give me some more money, I personally think that's a hard thing to do. So you've got to make a commitment to getting to know people early, bringing them into your fold, telling them when when they don't have to make a decision about should they commit to, the next fund. This is what we do. This is who we are. This is how we source, and then keep them updated a couple times a year, right? And go visit them once a year in person. And so that, doesn't always work, but often, if you get to know somebody and they continue to want to take meetings, they're probably pretty positively inclined to dig in and do the diligence the next time you're out fundraising. So 1% better on a lot of things.
Yeah, no, I think it's such a interesting and important concept. And sometimes it's hard to stick to that because you don't see 1% changes every day. It
Mhm.
takes years to see the compound effect of those imperceptible changes. But over time, you go from 17 years later where you're at now.
Yeah. I think I totally agree with you, right? But I do a lot of outdoor activities, hiking, climbing, right? And you find yourself, you know, um, start looking up at the mountain, going, "Oh my God, how am I going to find my way up there?" But it's one step at a time. And same thing in business, right? You take this 3 or 4 year strategy map, you break it down to year increments, you break the years into quarters, not exactly into months, but directionally. And then you keep tracking. You don't get everything right. You don't get all green. So we have green, yellow, red. We share with the LPs what we're doing well, what we didn't do well, right? But you keep, you know, grinding and pushing that stone up the hill. And then when you look back, you're right. You look back 2, 3, 4 years later. Wow, we've come a long way,
Well,
right?
I one of the interesting things that you're making me think about is like it's end of October now, and
Hmm.
we're in busy season, and it is back to back. The team can be worn down, but I
Uh-huh.
think it's a good reminder to tell the team, like, look at how many projects you are currently working on. Look at the skills that you are developing. Like, we will have our break. Right now we're sprinting, but
Yeah,
look at the change that's happening right now. You are growing. And sometimes I feel like for us, it might be difficult to pause and to do that type of reflection, especially when you're a, 10-person firm and you're just going so fast,
yeah,
to have that space to pause and to reflect, especially maybe as entrepreneurs, you're like, we could celebrate the wins more, and small or big,
yeah.
that we are making progress.
Yeah, and I think one of the things that we put in a number of years ago that's helpful to that is we call them SBRs or semi-annual business reviews. And so if you back up my calendar in terms of, trying to think about the firm and the strategy, Bob, Dan, Corey, and I get together a couple times a year in a multi-hour, multi-day meeting sometimes. And we lay out the next 2 or 3 funds, right? And we lay it out
Mm.
with what's the team going to look like by function. We lay out then the people. Um, if Kara was a associate to becoming a senior associate to becoming a VP to a principal to MD a partner, what does that career track look like over 5 to 10 years? Then you can take that back and have a personal development plan for every person that in the next 3 years, they've got to learn how to do X, Y, and Z. So that's point one. Point two is where are we going as a firm? What are the goals? And communicate that. So in January, the SBR, we lay out those goals that we decided on the previous December. We do a year in review, gut check. Hey, this went well. This didn't go so well. We uh, make sure that everyone in the firm, so everyone is there. All of our admins, everyone in the firm comes to that meeting, right? We do the first one in DC, the second one in Chicago. And then in August, we have a check in. We don't tend to lay out new goals and new things because um, I just think that's hard, right? And so we have a set of goals for the year, and then we're just checking and monitoring progress. On a personal level, we do reviews in February. In August, we have check-ins, 6 months later. How are you doing personally? What were the goals? How did those tie into the goals of the firm? Right. And so if you're doing the right things to advance your personal career and how what you're doing is important to the overall growth of Rotunda. And I think that's a really important way. And then lastly, we talked about it a bit, but it's transparency. If you're not sure, ask. If you're not sure, come sit down. If hey, how does this all fit together? And so I think that yes, people are sprinting, but people are always sprinting, right? There's a deal. We're buying deals, selling deals. We do 10 to 15 add-ons a year. So, we're trying to do, several platforms a year. So there's, on the execution side, the value creation team, there's more projects that they can shake a stick at. The finance team is trying to close 3 funds, every quarter and communicate with the LPs. Everyone's busy, right? But you got to take the time to pull back and celebrate the success. And then after every fundraise, we take the whole team plus ones someplace nice for a couple days.
Yeah.
Um, and I think it's also important to build culture that way and just take a breather.
That one of the lessons I got from Plexus Capital is that they have this exercise where they give shout outs to each other. And then that made us think about creating a Slack channel dedicated shout outs. Like I did one this morning at 8 a.m. Like we just finished an AGM video. And
Yeah.
that was like, it systematizes like taking that time to reflect and to recognize each other, of like, as opposed to just, all right, is this done? What's next?
Well, by the way, we're huge users of Slack. I think it's but we have the water cooler channel, which is
Yeah.
anything fun or interesting, and I really didn't mean this. It just happens to be sitting, here. But if you can see this,
Yeah.
we have a bunch of these Rotunda flags, and if you go someplace cool around the world, you take the flag with you and you take a snapshot and you put it on watercolor. But to your point, if someone does a really nice job, hey, congratulations. Well done. We, had a good firm event last week. We closed on a new platform. And I know it sounds silly, but Rona makes sure that if on everyone's birthday it goes on Slack and then everyone's pinging back. It's a lot of Slacks, but happy birthday, woohoo, have fun, right? It just, you know,
I
it's
love it.
it's a family. It's a family, you gotta treat it as such.
Let's transition over to your SXOs. So strategy execution officers, you just had a team meeting, bringing them all together where you're talking about accelerating value creation. So first off, like what are the SXOs
Yeah.
and what did you talk about at your offsite? Like where do companies get stuck and how do you grow them?
Yeah, so let's back up half a step. So we do this strategy map, and one of the problems that we found is the management teams were having, they've got a day job running the business. And they were having trouble getting to all the tactical things we wanted to accomplish to hit our strategy. The concept, other firms do it. LLR has a good program. Shore Capital has a good program. Alpine has their CIT program. So, we looked around, and actually, those have been, some of the people that we emulated. And net is these are folks that typically have MBA. They've got usually have work experience both pre and post MBA. Half of them are ex-military, which has actually proven to be a really great skill set to bring to bear in that role. But these are people that I sort of jokingly call them the Viking Roadmasters. They're chasing down all the tactical things we need to do so that at the next board meeting, did we get the employee survey done? For doing M&A, who's doing the integration, who's checking on both benefits, who's helping the CFO figure out chart of accounts, who's doing lease consolidation, right? So these are folks that want to be career path wise, want to be a CEO, a COO, or a CFO in the private equity context. And so the idea is that we put them out at one of the companies. We match them. So one of the things that's a little bit different about our program is we don't just arbitrarily send them to El Paso or Orlando. They get to choose, the location, which makes it harder, frankly, for us to figure it out. But also, we want the CEO to pick the person that they want. So we try and offer a couple candidates up because at the end of the day, this person is employed by the company. They are paid by the portfolio company. They have equity in that portfolio company, and they're a valuable part of the executive team. But then we try and help find them. We try and help assess them. We put them through the recruiting process. You mentioned the convene twice a year. We bring them back together. We share best practices. We try and also build a network and a community amongst all the different SXOs that are out there. Some of them have been promoted. One of them's a president in one of our companies today. We've got a couple that are in significant line operating roles, and then some of the new ones that have just joined the program that they have someone else to call. Hey, have you ever dealt with this? Or how do I do this? Or whatever the situation happens to be, we want them to form their own community to help each other. And they take a lot of pride. And I actually would say it's been a really interesting development. They want to interview the next SXO. They said we've developed something cool here, and we don't want some slacker coming in to the program.
That's awesome.
Yeah.
um, so how, let's shift into like how you grow companies
Okay.
and what's the, I know you don't like the words playbook, framework. So
Yeah.
like when you talk about accelerating value creation,
Right.
like if a company is stuck or just kind of puttering along, how do you accelerate that value creation? Like where do you start?
Yeah, I think the first thing is trying to the best you can understand the situation. Why is a company stuck? We have an internal process. We call it Sidewinders. If we have a company that's a little bit stuck, we bring the whole team back together on a monthly basis to talk about what they're doing, to brainstorm what we could do. Maybe it's do we need to think about a different strategy shift, or that's not a company that's stuck. But in terms of general accelerating value creation more broadly, again, you build the strategy map, you build out the tactics. I do not want to spend a board meeting talking about financials. That is a waste of time. We talk to our companies, we have weekly stand-ups for 30 minutes, we have monthly calls, quarterly board meetings. We're talking to someone on the team probably almost every day. Someone on my team is talking to someone at the company, multiple times a week. uh, we're getting, once the data set is up and running, we're often getting daily or weekly financial dashboards, right, on orders and revenue or backlog or production statistics, so that when we get to a board meeting, what I want to be talking about are, we said that, Jordan, you were going to get X done by Y date, maybe an employee survey, maybe a customer survey, maybe it was mapping out your processes so that we're going to build an ERP, right? And ERP is just automating manual processes. If you don't have clear manual processes, you're going to have a cruddy ERP when you get done with it, right? So what are the tactical steps that we're supposed to be doing? It's like building a house, right? You can't go building the second floor until the basement's been done. And then you got to frame the first floor, right? So let's talk about those activities. They don't always go well, right? They don't, right? But then what are we going to do about it? Right. And that's what the board meeting should be talking about, to use the Wayne Gretzky, quote, right? It's where the puck is going, right? Let's not drive in the rearview mirror with financial results. We get the financial results. I'm very cognizant of revenue and EBITDA and covenants and leverage, and there's a time in a board meeting for that. But that shouldn't be the focus of that's the tail of the dog, right? If you do the right things upstream, right? We call them wildly important goals. If you do the right things upstream and you measure the things that will generate the results that you want, that's what you should be spending your time talking about, right? If you like, simplistically, if you want to increase sales, there's only two ways to do it. Have more sales calls with higher efficacy, or raise prices. And then you can break those down into a taxonomy of different plays you can run underneath that. But it's, again, so for us, how do you accelerate value creation? It's this relentless drumbeat of execution, execution, execution.
So when you've partnered with a company and you're trying to figure out what the next chapter looks like, whether it's new products, services,
Mhm.
new geographies, or just the next chapter, like how do you figure out what that next chapter could be? We've been doing this business since 2019.
Mhm.
Our vision has become the one-stop shop. So we have to not just do more projects in these different service offerings, but also deciding, should we expand outside of this or should we not? Like, how do you go through that strategy mapping process to lay that out with the team? Like, here's what the future could look like.
And I'm not trying to be a smart aleck on this, but we think a lot of times when we meet companies, they don't know why they exist, they don't know where they make money, and they don't know if they're delivering a customer service promise, right? And fundamentally, if you can step back and answer those three questions. So one of the things we do, we call it the who cares and why. If you were to go out of business tomorrow, Jordan, who would care and why? And if you identify that clearly, then everything starts lining up, right? Then your financial strategy, your op strategy, human capital, all that lines up, marketing lines up. What we find is a lot of firms aren't very clear. These are firms that have been around 10, 20, 60 years. They're second, third generation often, right? They're very profitable, typically between 8 and 20 million of EBITDA when we start with them. But when you ask them, why did they win? And you ask the management team, it's crazy. This happens every single time. Oh, it's our great service techs. No, it's our locations. No, we've got deep inventory selection. No, we've got amazing prices. No, we have, stop. It's not seven things. It's like one, maybe two things. And that goes back to your question earlier about, strategy consulting or really understanding customer insights. So that's kind of point one. The strategy map process that we employ then is we sit down with the management team post closing almost immediately, and we build out this plan. What do we want to do? The company in Wisconsin, it's called VAD, right? They were 100 million revenue, making 14 million. So is the goal to get to 25 million? Is the goal to get 100 million of EBITDA? Like, those are very different places, right? And then we look at it as, if you look at, there's an example on our website, but we think about institutional capability, step one. Step two is process. Step three is customer. And step four is financial. You're going to have to change the institutional capability of a business if you want to grow. So let's be very clear that if we're going to grow from 100 million to 400 million, as an example, you're going to need to hire salespeople. You need to have a regional or national sales program. you know, let's lay out what the org chart is going to look like in 5 years, and then work our way backwards from that. You look at processes. Have you mapped your processes? Have you thought about efficiencies? Because if you're going to grow from, maybe you have one or two or three locations today, you can kind of manage it by driving to each of the locations. Now you're going to be in 14 states and have 28 facilities. You know, have you thought about how you're going to manage that across all those processes? Do you have that leaned out? Have you done the customer insights that we talked about earlier? Right? If you do those things and measure those things, then by definition, the financial results have to happen, right? Or should happen. Now, then there's the tactical part of executing all that. So then we lay out what are, what are the goals? We want to go from X to Y by when. Then we lay out the subparts. Okay, people freak out. Are you going to go 100 million to 400 million? Oh my God, there's no way. We've gone from like, it's taken us, 9 years to go from 80 million to 100 million. There's no way we're going to do this. Well, hold on. Do you sell parts? Do you sell service? Do you lease out some equipment? What are the different ways, and ideate with them on the different ways you could grow, right? And then sometimes you have to go research those different ways to grow and come back with, okay, we're going to rank order X, Y, and Z. To your point earlier, new geography, new product line, more salespeople, all that is different viable
Mhm.
tactical execution. And then it's the drumbeat. A strategy map is as important to lay out where you are going to go as also where you are not going to go, right? If it is not on that map, we're not doing it. And a lot of entrepreneurs get excited about the shiny object syndrome. Oh, okay, we could do that. Oh, we could do this. Stop, right? And maybe it's a great idea. And if it is, we don't need to be pedantic about the strategy map. We can basically revisit it, and we should touch on it annually or 18 months. And if there's a new opportunity that is so much better, great. But let's agree as a group that we're going to make that shift. And then it comes out is the alignment between the management team is crisp and clear on what their wildly important goals are for the year, how that fits into the long-term strategy, how are they compensated? So, half of it's on EBITDA growth, half of it's on these other called qualitative things that they need to do with the business. How is our value creation team lined up to deliver, the projects that help them achieve their goals? And how is the execution team, which stays cradle to grave, how are we helping with M&A? How are we helping with financing? How are we helping with, strategy? So I'm not saying we are there. I'm saying I'm
Yeah.
never going to be satisfied, but that it's trying to line all those things up and just get after it.
Well, it's so interesting because like in the past month, I've had um, kickoff projects with 3 different portcos from a couple sponsors, and these do 50 to 100 million in revenue. And I was like, okay, I kind of like to ask a question like, why am I here?
Yeah.
And it's funny because we'll spend 1 hour on basically some version of we don't know who we are.
Yeah.
And this is a 50, 75, $100
Well,
million company.
every time. Every time.
And I,
But look, as a family founder owned business, they started the business and they're scrappy and they're entrepreneurial. And let's say true story, it's a company we used to own, right? They started by selling fruit and, to restaurants. And then they got into grocery stores, and then they added vegetables, and then they added proteins. And then they did this, and then they started making stuff for airports. Like you get a pre-made salad or a sandwich, or like, and you're like, why do you exist? Uh, and I don't mean to be critical. These guys are tremendously successful, but a lot of them are living week to week, month to month, dealing with the fires, right? We use 4 disciplines of execution. You could use EOS, you could use traction, you could use gazelles, you could use OKRs. They're all kind of the same at some level, right? Have a plan, build the goals, follow the goals, right? Um, and a lot of these guys are like, look, I have $100 in the checking account at the end of January, and I have $112 in the account at the end of February. That was a good month,
yeah.
right? And they're these guys work incredibly hard. These families, they take care of their employees. They're trying to satisfy their customers. Sometimes they're just not stepping back to have a different perspective, which is what I think an outside investor can do. And I'd like to think, whether it's ourselves or other really good firms out there, like, there's lots of different very good private equity firms that can also bring a little bit of intelligence on, hey, we've done this several times, right? And here's what we've seen work, and here's what we've seen maybe not work
Well,
so
and it
well.
shows them what the future can look like down the, 5 years. Here's what good looks like. Um, And I
Well, they
think it's,
also can also just say that look, and maybe this would be me. If I was making $18 million a year and I own a company, so I'm making every month I'm getting 1.5 million in my bank account. I'm not sure how hard I'm actually working to turn that into 2 million or 3 million, right? And so they get very comfortable and they don't want to take risk, right? And they think, hey, why do we need a new ERP system, right? The one we have from like 1996 is fine, right? But it's not fine, right? It doesn't give them
yeah, it
insight.
goes to like, okay, great idea, but what's that going to do for me? Like,
Well, you could scale, and then they're like, "Why do I need to scale? I'm making $8 million a year,
yeah.
right? The life's pretty good." So I think
Well,
sometimes too, we've seen where you take the financial risk off the table, it opens them up to possibility, and it's really cool to watch for the CEOs that or the founders that want to stay on.
yeah.
But when they put a bunch of money in the bank, boy, do they want to go.
So this, I think, brings us to the next question, maybe a good place to kind of round this out, which is how have the CEOs who have successfully evolved from maybe founder family owned to the next stage of ownership, or the ones who have gone through multiple stages of ownership, they've just
Mhm.
continued to evolve. Like, are there common threads between the CEOs who have evolved, and how do they do that?
Yeah, it's funny. I literally was just having this conversation with Tom at Worldwide Express. I mean, it was low single digits of EBITDA back in the day when we bought the company. It was 16 when we sold it to another PE firm. By the time they got done consolidating up their network, it was 50. They merged it with another company. Then it was 100. And today it's several $100 million of EBITDA. And Tom's still the CEO. And, he and I were having this exact conversation like 3 weeks ago about it's a growth mindset. Um, but it's also this is a hard thing to say, but there are people that you will bring onto your team that are good from here to here, but they're not going to be able to scale and change. It doesn't mean you have to fire them. It just means that maybe they get to a point and then you have to bring in somebody else that can get you to the next leg. And that's a hard thing for a founder to do. But the good CEOs that have been able to grow, there's a Buddhist analogy, right, of the shell, right? Like think of a conch shell that spirals around, right? When the animal gets big enough, that shell constrains it, and it can either stay that same size, but if the animal wants to get bigger, it's got to shed the shell. And so having that it's a painful experience to go through. It's risk, right? Everything that's made me successful, I have to kind of delegate that or give that to somebody else. And I personally have to learn how to be a better leader, right? I have to learn how to delegate and work through people that a lot of entrepreneurs, we have a culture of doing, not a culture of thinking. What I mean by that is they do this, they do this, they do this. And instead they've got to build a culture where they lay out the strategy and they said, look, this is where we got to go, but they don't do everything, right? The other analogy is you can tell me what to do, you can tell me how to do it, but you can't do both. And that's something a lot of our leaders have to learn, which is if you've hired a head of sales and the goal is to go from 100 to 200, maybe they're not doing it the way you'd want to do it, but that's what you hired them to do. Let them go do it and keep them
Right.
accountable for results. But just because they don't do it the way you would want to do it doesn't mean it's wrong. And that's a
Oh,
learning for a lot of our CEOs. It's learning. Hey, it's a learning for me. I'm still learning. I'm still evolving.
but that point made, really resonates because over the past 6 months, we have newborn twins, 6 months old. We have a 9-year-old and a soon to be 6-year-old.
Yeah.
Newborn twins. And then when my wife, who's also my co-CEO of the business and truly runs, we run this together. When she was out, like, don't talk to me about invoices when I'm trying to nurse twins. Like, I was
Yeah.
like, and that happens at month 1, month 2, month 3. I went into like this, I needed like this to start something new, and or to think of these different ideas for this business or for other businesses. And it made me started to think like why am I doing this process?
Mhm.
And what I have come to realize is that it's not that I'm a 0 to 1 person, it's that I didn't know how to go from a 1 to 10 or a 1 to
Mhm.
5.
Mhm.
And to the point about growing out of that shell, like, I didn't recognize that I was outgrowing this shell, and it's gonna be painful to go to that next level. And I was at I was at a client site a while back,
Yeah.
and they were discussing the current executive team and just kind of going through like, hey, we're probably gonna need to replace it, and made me like a fly on the wall, be like, how do I make sure that I evolve, that we evolve to that next stage, so that the team, the clients, if we ever take on investors, that they're like, heck yeah, we want to keep that person, they're growing.
Hmm. Hmm.
But it come to that point of like, I was trying to do another idea because I wanted to go 0 to 1. And I'm very good at that skill set, 0 to 1. But I need to develop the, how do we grow from 10 people to
Right.
25, which is a whole 25 to 50 in these
Yeah.
functional skills that I have to learn how to develop.
Yep. And I look, at the end of the day, if you have a growth mindset and you're willing to take chances and try, that gets you a long way down the road. But it's going to be hard. It's going to be painful. We've had to part ways with people both at Rotunda and at Porco's that, couldn't get any further. Right. But at the same time, you don't need 1,000 chiefs and, everyone wants to be the C of this and the C of that, chief marketing, chief, C suite of this. And you need people that are really functionally capable too, right? And that can, reward them and build a career and, challenge them intellectually and reward them financially, but they're not going to end up running the place, right? You got to have both. But I've used an executive coach for years. It's been massively helpful to me. Her name is Sloan Klein. She's fabulous. And she helps me think through this and she keeps me honest on, hey, am I tracking towards my personal goals, my professional goals? Am I avoiding making the hard decision? So I think having an accountability partner, um, outside of, just to sit down and basically, once a month or once a quarter, whatever your cadence is,
Yeah.
to take the time to sit back and reflect. And, before I have a meeting with her, she sends some questions, we have monthly to-dos and then we have, follow up. It just puts me on a cadence of getting out of the whirlwind of daily activities, right? Of just stuff that happens. And it's
Yeah.
easy to lose sight of the strategy, but then you got to push yourself and take risk.
Um, Maybe shifting over to climbing mountains.
Hmm.
You you went up 18,000 feet with Mount Kilimanjaro in Tanzania. Uh, what did you learn from that experience? I know when I do some endurance activities, I learn a lot about myself. So I'm
Yeah.
just kind of curious, what did you get out of that experience?
Yeah. So 18,000 sounds great. It is not the summit. The fall summit's at 19.1 and the real summit's at 19.4, more or less, but 18,000 is high. Um, it's interesting. I trained for months and months to get ready to go there. And I've never had this happen to me before. You started about 5,000. So we were driving up to the mountain and we were getting out and the porters were sorting all the gear. And, we had 10, 11 people in our group. And so there was, hundreds of pounds of gear that had to go. And you saddle up on your backpack and I almost had a panic attack. I don't know how else to explain it. I almost freaked out at the base of the mountain. You're so close to the mountain, you can't even see the mountain, if that makes sense, right? You can, because it's steep and we're in a rainforest. You start in a rainforest and you end up in alpine, snow covered territory by the summit. But I was just like, I can't do this. I can't do this. And yet I trained for months. I've been doing other outdoors and I finally had to calm myself down and just say, look, take one step. Literally, I remember saying that, I almost quit in the parking lot. And I was like, just take one step. You've always wanted to, I've had this dream of climbing Kilimanjaro for years and years since I was in college. Take one step. And I took a step and then I took another step. And then, okay, we're going to go for 20 minutes, right? You can do 20 minutes. Right. And then, okay, I can go another hour. And then, the first day you go 5,000 to 10,000, and it's muddy and you're in the rainforest. It's an uphill slog. It was really hot. I was not dressed appropriately. I was overdressed and sweating and gross. And but then you get into a rhythm and then you find it and then you pull your head up and you look around. And if you've ever been on Kilimanjaro, it's like Dr. Seuss. There's there's 4 or 5 different eco-climates along the way from base to summit. The trees, the animals are different. But the other thing is, I didn't summit, and it was a really hard push. You leave out at 11:30, about 3 in the morning. I got to the point. It was very steep. It was icy. I was really struggling, and I had made a commitment to both myself and my family that if I got to the point where I didn't feel safe, I would turn around. And I finally stopped the guide and I said, look, the most of the other people had gone ahead of me. I was really, really struggling. And I pointed up at the summit. I could see people on the summit because, it's the middle of the night. You can see their headlamps. I could see people up there. I knew I was close. And he's like, I said, how much longer? He goes, at this pace, 3 to 4 hours. And, and I promised myself I was going to have the discipline to turn around, because what you don't realize when you're climbing, right, is when you get to the top, you're only halfway, right? You're only halfway. You've got to come down. And I'm like,
What goes up must come
must
down.
come down. And if you're exhausted and you're unsafe, most accidents happen descending. And, and it's not a technical climb. I would jokingly say it's the world's longest walk up, but it's not, it's very hard. But I turned around and I went down, and I remember we got down to camp. I think where we left out was like 15.5 or something like that, and I've never been that tired in my life. I had 5 layers on top. I had 4 layers on the bottom. They said, why don't you go in? You can sleep for a couple hours. It was about daylight. It was about 5:36 when we got back to camp. It took me a half hour to get out of my clothes and into my bag. A half hour. Like I just was exhausted. And then we started down the mountain before the rest of the people. They were still summiting. They were going to come down, and then so we got going down. And you have to come from summit 19,000 if you make it. In my case, 18, and you get down to 10,000 that day. So it's an 18. It says 15 to 18 hour day of just nonstop physical activity. And as we're walking down, it was just one guide taking me down. I just had this terrific experience. This is why I love travel. I absolutely love cultures and foods and people. And I asked the guy, I said, do you have family? And we talked about his girls. And, I stopped him. I said, do your girls do sports? I have a daughter. I've got 2 sons and a daughter, and they're all athletic. And he looked at me, he said, in my culture, girls don't do sports. And we ended up having like well, critical, like it just, I said, well, tell me about that. And so here I am in a lot of pain. And then for like an hour, we talked about his culture and how he grew up and why is he a mountain guide and his family. And I just loved it. Like I was totally distracted. And you coming off the Kili, and it's like the moon. There are no trees. There's no plants. There's no nothing. It's like you're walking on rocks as far as you can see. And your toes are hurting because you're coming at a pretty significant downslope. It was just, but even at the very base of the mountain, 2 days later, a day later, whatever it was, the feeling of accomplishment. Yes, I didn't summit, but I'd done something I dreamed about doing for 20 years. I felt proud of what I had done. I had trained for it. And I really pushed myself. So, it was just I have a picture in my office from one of the days that I took at the tents, and the light is just falling on the mountain as the sun's going down. And it's just inspiration to me to keep, putting one foot in front of the other.
That's fascinating. And I think that there are so many lessons, and it's interesting how, certain personalities just don't know when to pull back, because part of what makes you successful is that you don't pull back. You just keep going. No matter how many times you just get punched in the face, you just keep
Yeah.
going. But having that self-awareness to be like, no, I know that this is my point when I do need to stop this.
Yeah. Yeah.
And
I do a lot of diving. It's the same thing, right? There's always another dive. There's always another thing. But if you're unsafe, I've seen people lose weight belts. I've had my buoyancy vest, the O-ring burst and losing, hundreds of pounds of pressure very, very rapidly. So I needed to make a safety stop and ascend, right? You've got to operate within your limits, right? And if you operate within your limits, there is another day. You can go back and do it again, right? And so you've got to minimize risk. This is not risk free. I get that. But if you operate prudently, and you don't basically stretch and let your ego get ahead of you and just say, it's not happening today. But it doesn't mean it's a failure. I didn't summit. It's still one of my life's biggest successes.
that's awesome. And I think it's a great place to end this.
There we go, brother.
Thank you so much for taking the time to do this. This is
Jordan, this has
fantastic.
been fun. I know we've talked about doing it for a long time. So thank you so much for having me on.
That's great.